Hey everyone, welcome back. My name is Zane. Today we're looking at Anchor Protocol. Anchor has been doing extremely well within the last 7 days alone. Now obviously a month ago, Anchor was doing extremely well, $2.23. But lately the price had a big hit. Obviously the market kind of crashed. Anchor went to as low as 0.05 cents, literally 5 cents per coin. That was extraordinary, and a lot of people saw a great opportunity to buy into this crypto and to make a lot of money, and so they did. Now obviously this video is not financial advice, it's strictly for educational and entertainment purposes. But how the hell did Anchor had such a good recovery? That's the question. How did Anchor have such a good recovery, and how did you miss it? Because it seems like people missed this opportunity, including me, including maybe you. How did we miss this opportunity? Because a lot of people made money right here, a lot of people, and we kind of missed the opportunity. Obviously, this is in the last 24 hours, and since then, it's fell back down just a little bit. But a lot of people might be thinking, well, this is another great opportunity to buy some more tokens and wait until it goes back to 55 cents. Yes, let's do that. But once again, not financial advice. So in order for us to understand this, I have an article from The Verge, how the Anchor protocol helped to sink Terra. Obviously, everyone is scared of what happened to Terra right now. This article is going to help us to understand why Anchor had such a great recovery and how was Anchor involved in depegging Terra. Seriously. Combative co-founder of Terraform Labs, best known for the ongoing disaster that is Terra Luna. Wow, what an interesting article. It's a great way to start an article, by the way. So how did Anchor have something to do with the Terra falling, right? So as this article says, let's say I want a higher rate of return than I could get in a regular savings account by buying, for instance, government bonds. So I deposit 10,000 worth of Terra, the dollar peg coin in the system. Anchor then turns around and loan out my deposit to another investor who we'll call LAR. But to make sure he's good for the loan, he's got to put down some of his own assets as collateral. Some of the yield from LAR collateral come back to me, as does some of the interest. Crucially, the deposit and the interest are in Terra. Wow, this sounds interesting. So this is not specifically revolutionary, and it's also why we don't understand the 20% rate, since borrowers were also getting rewarded for borrowing. You understand that? Borrowers were getting rewarded for borrowing. So why did the money come back? Back in January, people were already warning that Anchor was unsustainable because there weren't enough borrowers. The most charitable thing you could say about that 20% is that it maybe was meant as a customer acquisition strategy. So it was just a way to convince people to buy into this thing, to use the Anchor. And the APY was going to be revised lower later. Other people said other things. For example, some said it looks like an obvious Ponzi scheme. And it kind of was if you think about it, what a Ponzi scheme represents, where money from later investors were paid to earlier investors as interest. You understand that? So if someone borrows your money, me as a later investor invest in this thing, and some of my money goes to that person. It's a circular motion. And this has happened before in the crypto world. It's nothing new, but it's just a little bit different. So as much as 72% of Terra, according to Decrypt, Anchor created demand for Terra. Unlike stablecoins such as Tether and USDC, Terra wasn't directly backed by reserves. Instead, it was known as an algorithmic stablecoin, which attempts to stay at $1 through a process of arbitrage with a sister token Luna. So the problem with algorithmic stablecoins is that they all fail. They fail because they rely on things they can't control, investors' demand, people who will perform the stabilizing arbitrage, and reliable price information. In the specific case of Terra, it seems likely that an unusual, large withdrawal knocked the system out of balance. After that, there was a death spiral, just like Quant's other projects. Basis, similarly, non-quant related algorithmic stablecoin like Iron and Neutrino have also tanked in the past. But here's how Anchor weighs investors down. People who had deposited their money couldn't remove it when Terra fell. Interesting, isn't that interesting? And so unfortunate. People who knew better, who saw the warning signs, even did little to stop naive investors. The founder FTX listed Terra and Luna on its exchange despite having a pretty good idea of what's going on to happen. So here's him discussing it on the Odds Lots podcast. If you zoom out, right, and say there's a stablecoin backed by a volatile asset, what's going to happen in a big market move, right? Like, you know how this plays out. So they knew exactly what they were doing, but it's business at the same time. So if they can make money, they're not going to say no, are they? And apparently there were winners in this. And of course there were winners. And those winners were insiders. Parental Capital, for instance, made $170 million on $1.7 million investment. The New York Times reported anchor investor Hack VC got out of Luna in December. Venture firm CMCC Global sold off in March. So some people knew that something was going to happen, and they were smart enough to sell quick and fast to get out of the market without losing their crypto. But some people stayed because they actually believed that Terra was going to be like Solana, that it was going to be like Ethereum, or it was going to be like Avalanche. But behind the scenes, there was a lot of funny behavior. And unfortunately, there's a lot of investors who don't look into it deeply enough. And that's just how difficult it is to be in the crypto market. It's never going to be easy, not for anyone. Because you have to do your own research. And what people don't do is do their own research. People don't like to do their own research. And that's a fundamental problem. If you don't do your own research, you're going to get screwed half of the time. Now, me personally, when looking at the Anchor protocol, I definitely think it can get close to $1, maybe 70 to 80, but it's kind of unpredictable right now, especially with it being linked to Terra Luna. It's really unpredictable. But a lot of investors are just going to use this as a way to make more money because now they understand where the bottom of this token is. It's around 5 cents. And the lower it goes is the more they'll invest just to make a quick margin. So that's my prediction for the price. I definitely think it can get back to around 70 to 80 cents, maybe even $1 with the next bull run. But like I said, investors are mostly going to use this as a way to just gain into the market, to just be a part of the market and to make a quick buck. It's not a long-term investment. It's just to make some quick cash. The majority of the crypto market is looking red right now. Seriously, some of them were in recovery mode for a few days, but in the last 24 hours, my mistake, the fact that Anchor is going down in the last 24 hours is not necessarily Anchor's fault. The entire market is going down in the last 24 hours. But thank you for watching this video. Subscribe to see more, and I'll see you in my next video.